Hello, everyone, and welcome. Today, we're diving deep into a really critical and honestly a pretty misunderstood part of the new Income Tax Act 2025. We're talking about Section 69, which deals with the tax on share buybacks.
So, let's just start with a simple question. Imagine a company wants to buy back the shares that you own. You agree, you get the payment. Sounds straightforward, right? Now, the big question is, do you have to pay capital gains tax on that profit? Your gut instinct probably says yes, but as we're about to find out, the law has a very interesting twist.
Here's how we're going to break it all down. We'll start with the basics of what a buyback means for a shareholder. Then we'll look at the general tax rule, and right after that, we'll uncover the really powerful exception that changes everything. We'll even walk through a clear example, talk about compliance, and then wrap up with the key things you need to remember.
Okay, so first things first. Let's make sure we're all on the same page about what's actually happening during a share buyback from a shareholder's point of view.
So for you, the shareholder, your shares are a capital asset. When the company buys them back from you, what you're really doing is transferring that asset. And under our tax laws, anytime you transfer a capital asset for some kind of payment, well, that's a taxable event. It immediately brings the whole concept of capital gains into the picture.
And that leads us directly to the general rule. This is laid out very clearly in the first part of Section 69.
We all know this, of course. Capital gain is just the profit you make when you sell something. You take the sale price, subtract what it cost you to buy it, and there's your gain. This simple idea is the foundation of the general rule here.
And Section 69, subsection 1 puts this into law. It says, plain and simple, that the difference between the money the company gave you and what you originally paid for those shares, well, that's your capital gain. Now, for those of you familiar with the old 1961 Act, this should sound a lot like the old Section 46A. It's the default, the standard way of doing things. But this is where the story takes a very interesting turn. Because you see, there is a huge exception to this rule, one that completely flips the script on who pays the tax. Let's see how that works.
The entire picture changes based on just one thing. Did the company buying back the shares pay something called a buyback tax, or BBT, on that transaction?
Now, this buyback tax isn't really a new idea. It's carrying forward the principles we saw in provisions like Section 115QA of the 1961 Act. The whole point is to tax the profit being distributed by the company, but to avoid taxing the same money twice, once in the company's hands and again in the shareholders'. So it creates a choice. Either the shareholder pays capital gains or the company pays the BBT.
And this leads us to the heart of it all. Section 69, subsection 2. The law couldn't be clearer. It says that if the company pays the buyback tax, then for the purpose of calculating your capital gains, the money you received is legally deemed to be nil. That's right, zero.
This table just lays it all out perfectly. Look at these two different worlds. On one hand, if no BBT is paid, the tax burden is on you, the shareholder. You calculate your gain using the full buyback price. But if the company does pay the BBT, the liability completely shifts. For you, the consideration is treated as nil. And when you subtract your cost from zero, what do you get? A capital loss for tax purposes.
I know this can feel a bit abstract, so let's just plug in some simple numbers and make this crystal clear.
So let's say you originally purchased your shares for 1 lakh rupees. That's your cost. And now the company is buying them back from you for 2,50,000 rupees. That's the money you received.
Now just look at the difference here. On the left, we have outcome 1 where the company did not pay BBT. Your calculation is simple. 2.5 lakhs minus 1 lakh gives you a taxable capital gain of 1.5 lakhs. But on the right, outcome 2, the company did pay the BBT. Suddenly, your consideration is deemed to be zero. So, 0 minus your cost of 1 lakh, and you have a capital loss of 1 lakh, which you can potentially use to offset other gains. It's the exact same transaction, but two completely different tax outcomes.
So given that these two outcomes are so different, the most important question is, which rule applies to you? And this brings us to the practical side of things, compliance and the common mistakes to avoid.
Here's your 4-step action plan. Step 1, and this is the most critical of all. You must verify if the company has paid the buyback tax for this specific transaction. If they did, then in your tax return you report the sale consideration as nil and claim that capital loss. If they didn't pay it, then you just proceed normally and report your capital gain. Everything hinges on that first step.
And these are the traps we see people fall into over and over. The biggest one is just assuming that a buyback always means a taxable gain for you. Both professionals and taxpayers have to be proactive and check the company's BBT status. If you don't, you could end up overpaying tax by a lot,
Or, just as bad, you could miss out on claiming a legitimate capital loss.
All right, we've covered a fair bit of ground. Let's boil it all down to the most important things you need to walk away with.
Just remember these 5 points. 1. Section 69 is the law that governs all of this. 2. The default setting is that you, the shareholder, pay capital gains. 3. The absolute game changer is the exception, which kicks in if the company pays buyback tax. 4. This exception makes your income from the sale nil, which creates a capital loss. And 5, and this is the most important action item for you, always verify the company's BBT status before you file your return.
And that leaves us with one final thing to think about. Since a company can now essentially decide whether the tax hit is taken by them or by their shareholders, how do you think this might affect their financial strategies going forward? Will more companies choose to pay the BBT themselves to make the buyback more attractive and tax-free for their investors? Or will they avoid it to hold on to their cash? It's a really fascinating strategic question to ponder.
Thank you so much for joining me for this explainer. If you found this breakdown of Section 69 useful, please do hit that like button, subscribe, and maybe share it with others who could also benefit from it.
Please remember, this presentation is for educational purposes only and is not professional advice. Tax laws can and do change, so please consult with your professional advisor before taking any action. This is an AI-generated educational presentation.